Is the Great Reset upon us? And has the Great Reset now been fully priced into the stock market? Let's talk about the Great Reset, the stock market, and what to expect going forward. Let's start. First, we are experiencing the greatest inflation that we have seen in the last 40 years, with expectations that at least in the United States, the peak has not been achieved yet. In fact, the next CPI data set for July is expected to come in even higher than that of June. The same is true in markets around the world. We are fighting substantial inflation to which central banks around the world, more than 70% of them, are raising interest rates quickly to tighten financial conditions, compress the wealth of individuals so that finally they spend less money, and hopefully inflation goes down. Because the worst thing for an economy is runaway inflation, because it leads to the collapse of currencies. Well, folks, this is also compounded by the fact that individuals' incomes, because of high inflation, is plummeting. This is a chart of changes in real wages versus 2021. We've got the United States marked in blue here. And you can see we're doing far better than the rest of the world, where places like Italy, Spain, and Greece are having substantially larger decreases in wages. And so naturally, it makes a lot of sense that misery throughout the world is rising substantially. In fact, if you take a look at the COVID spike of misery right here, we are slowly approaching those levels of misery again. These are the misery indices for, in white, the United States, in blue, the United Kingdom, and in orange, the Eurozone. But before we draw any conclusions, I have to remind you to enjoy this slide here that suggests that more than 70% of those in the United States believe a recession will happen by the end of 2022, with another 9%, so a total of 80% of individuals believing we'll see a recession between now and 2023. And this is where you want to make sure to take advantage of the data the Atlanta Fed provides to us. Take a look at this now updated as of today, Atlanta Fed GDP Now real GDP estimate for the second quarter of 2022. It provides that for the entire first half of the year, we actually had negative GDP, potentially, this is not the official figure, of negative 1.7%. Unfortunately, a negative GDP for 2 quarters in a row, or 2 sets of 3 months in a row, in other words, potentially the first half of 2022, implies that we already are in a technical recession. The GDP Now index has slightly moved up, as you could see here, from negative 2.1% to negative 1.9%, with an average of a negative 1.7% read for the entire first half. And folks, unsurprisingly, the bond market, which often can predict what happens in markets and financial conditions, is telling us that we're due for another recession. See, when this chart has a negative read, as you can see it has right here, a negative read, which was once seen here, again seen here, and again seen here, tends to come right before these red vertical bars. These red vertical bars represent recessions. And folks, take a look at this. We have once again inverted in the spread between the 2-year and 5-year Treasury yields. Now, you don't have to know exactly what that means. Just know that when this chart behaves this way, it tends to precede a recession. And that's why this chart is so important, where you could get lifetime access to amazing fundamental analysis, Lowe's partnerships that pay for your membership, Q&A every day the market is open, buy, sell alerts, diversified M1 finance pies, and locking in a price for life with a one-time payment when prices usually go up on average $50 to $100 per month. Folks, if you use coupon code FIREWORKS, you can get 50% off before the next price increase. You want to lock in that price because new content is regularly added. And folks, thank me so much that we regularly provide this lifetime access forum where you can communicate with other savvy investors and receive new lectures on a regular basis, providing you the insights and information that you're looking for. You are very likely to more than pay for the cost of joining and getting lifetime access within the next year alone, if not even within the next few months. And then you essentially have lifetime access for free. So check out the coupon code down below. Check out the programs on building your wealth, and make sure you join before the expiration of this coupon, because prices will be going up again, especially since we have a massive lecture set coming out tomorrow. But folks, the bond market tells us in multiple ways that a recession is around the corner. I just showed you the spread between the 2-year and the 5-year. Well, we also have a spread of the 10-year versus the 2-year, which is sometimes considered an even more reliable indicator of a recession coming when a 2-year treasury yield is more expensive in the short term than a 10-year treasury yield. We get an inverted curve. And we had that here on April 1st. We had that very briefly here for a few hours. And take a look how deeply we have presently inverted. The bond market is telling us a recession and a great reset is here and coming. And so it's no surprise that in real estate, we are seeing the number of homes with active price drops skyrocketing, which is a prelude to actual reductions in sales prices and potentially negative real estate gains. But we're also seeing investors in the stock market turn to hedges, buying puts, and taking up options on the VIX. The VIX is known as the volatility or fear index. And the more we see investors via this white line take up positions or bets on the VIX, the more investors are telling us we think more bad might be around the corner. You could take a look at this chart here, and you could see that we have seen the largest amount of purchasing of call options in the VIX, which means individuals are making a lot of bets that volatility and fear is about to skyrocket. And they are doing so at the highest levels that we have seen since the COVID panic. Folks, that is a red flag that at least the institutional investors and hedge funds believe more pain is ahead. After all, we have not seen what's known as a cathartic flush out yet in the stock market. This orange line set here represents spikes in the fear index. It's inverted. So the more it goes down, the more fear there is. In this case, it's upside down, right? It's inverted. And you can see these massive fear spikes. Once here during the dot-com era, you could see the fear spike here during the Great Recession. You could see the beginning of the taper tantrum here, the continuation of the taper tantrum slightly over here, the COVID pandemic panic here. And look at where we sit now. Really a massive lack of fear, a lack of what folks are calling for, which is that cathartic flush out that says fear and capitulation is now at such a high level that now is potentially the time to buy. But we haven't seen that yet. However, folks, take a look at the logarithmic chart of the S&P 500 going all the way back, my friends, to right here, the Great Depression, 1930. What we see here is a lot of pain over time in various different cases. You could see a 22% drop in 1.2 years here, a 28% drop in 6 months, a 22% drop in 8 months, a 36% drop in a year and a half, 48% drop in 1.8 years, 27% drop in 1.8 years. Look at this one, 36% down in 2 months. Folks, we sit right here, 25% down in 5 months. And this logarithmic chart shows us that over time, what happens, folks? Stonks do this. Now, that's not to say that this is the bottom of the market or that you should hop in with everything you have and it's time for YOLO call options and it's time to get into margin. No. In fact, I'm very proud to say that right now, I have zero margin. I'm completely out of margin, and I recommend that you be completely out of margin as well, because if we do get a capitulation panic and we do get a cathartic flush out, you might not survive this line. If we end up getting a deep spike over here to the downside and you're heavily margined, you could get wiped out. And the key in this market is to survive. You want to be a survivor. And folks, what are people doing right now who potentially want to survive but are making bets on beaten down stocks? We'll take a look at this. ARK is seeing a burst of inflows. Here, you can see the price of the ARK ETF has risen just recently. And as this rise has occurred, so has buy the dipping in ARKK. This is the most consistent stretch of buy the dipping that we have seen in the entire year. You can see this by simply counting the bars. 4 bars plus this little one here is actually a plus. That's 5 bars. This is 8 bars of positive net inflows into ARK. That is the longest stretch that we have actually had since January, where we had 4 bars in a row. Otherwise, all the bars going down were net outflows. So you can see the consistent buy the dipping is happening right now. And people are placing bets on innovation, on sold off technology trades. Even Warren Buffett is buying the dip. Warren Buffett is, of course, buying the dip in Occidental Petroleum with now a total share count of over 17.6% ownership in the company. But take a look at how Warren Buffett buys. He buys when people are fearful. He's greedy, as they say, when people are fearful. And he actually does so. Sure, he bought here on the rise at the beginning of the war, but he bought the dip here, he bought the dip here, he bought the dip here, he bought the dip just a few days ago. Warren Buffett is buying. Individuals, while some institutions are hedging, individuals are buying innovation. They're buying the future of America. And it makes sense, because what are we seeing? We are seeing the highest fall in technologies. And why is that, folks? It's because some folks are saying the end of June saw the highest amount of outflows of technology or money in technology funds, and that maybe now is officially the time to go in and buy the dip. That maybe the bottom is in. And the way we're going to buy the bottom is we're going to buy while hedging for a volatility spike. And why are people doing that? Why are people all of a sudden buying the dip? Well, it's because we're finally actually starting to see some signs that maybe inflation could be transitory. Now, that sounds very offensive to a lot of folks, because the idea that inflation is transitory sounds like a hoax. It sounds like a lie. They told us that after the COVID pandemic and the panic of COVID, that we might have some transitory reopening inflation. First, because of, who remembers the phrase, base effects, where when we compare back to the prior year, we compare into a whole. The base effects tell us, oh, we should have high inflation. But they also tell us that, hey, wait a minute. Not only do we have this, but we have a reopening. So people are going to spend money again as we reopen. Well, this was the first potential sign of inflation coming and going. Unfortunately, this sort of balloon of inflation, even though we had declines in inflation in the summer of 2020, what ended up happening in the fall of 2020? We got the Delta variant. And we immediately destroyed supply chains with Chinese shutdowns again. COVID pandemic first, Delta variant next. What came after the Delta variant, folks? Omicron, to destroy supply chains once again and really put a nail in the coffin of supply chains. COVID was now lasting. Inflation was lasting. So, what happened thereafter? Well, we got a war that didn't end up ending in May like many had hoped, including myself, but is now potentially lasting for the rest of the year. And so folks are finally looking back to signs that maybe inflation has potentially peaked. Here is a chart showing us commodity prices and how they moved from 2021 to 2022. You can see massive moves in commodity prices up 45%, food prices up 68%, oil prices up 148%, and metal prices up 56%. But what have we also seen since the peak in the second quarter of 2022? Declines across the board. Commodity prices down 8%, food prices down 8%, Brent down 8%, and metal prices down 23%. Some are now saying that the peak is in. And if the peak is in commodities, then maybe we'll actually start seeing gas prices come down as well. And that's exactly what we've seen. We've started seeing gas prices come down. So what does this mean? And is there potentially a really important chart that we have to pay attention to and understand, because it could be a signal of what's right around the corner, which could be critical to your investing future? Absolutely. We're going to talk about that chart right after a message from our favorite sponsor that all of you love so dearly, the Motley Fool. Guys, the stock market is all over the place right now, and unless you want to be like me and research the market for hours every single day, I recommend checking out the Motley Fool. The Motley Fool Stock Advisor is a subscription stock picking service and has been providing expert guidance for over 20 years, meaning they've seen the market at both its best and worst times. Members gain access to their library of expert stock recommendations, and the expert team of analysts at the Motley Fool recommend 2 brand new stocks every month. They send it directly to their members' inboxes for you to review and make your own determination on. Over 1 million investors use the Motley Fool Stock Advisor, and it's been ranked as the #1 investing newsletter by the Wall Street Survivor for 5 years in a row. Stocks go up and down over time, but the Motley Fool believes that over the long term, anyone can easily build their nest egg that they need for an early retirement. Financial freedom could be right under your nose, and today, the Motley Fool is offering its top stock picking service to new members. For just $79 a year for the first year, this is 60% off their usual list price of $199. So visit fool.com/Kevin to access this introductory offer for new members. Again, the link in the description down below will get you their stock picking service with at least 2 new stocks every month for just $79 per year for the first year. Link below to start getting top-notch stock picks sent directly to you by the Motley Fool today. Now, before I show you the chart that is so critical, let me just reiterate to you falling commodity prices. This is the Bloomberg Commodity Price Index. Commodities are a huge leading factor in inflation. Commodities go down first, then input costs fall. Then we see producer prices fall, then we see consumer prices fall. And so what are we seeing? We are seeing almost all of the gains of commodity prices since February being eradicated. And so now, let's take a look at what becomes extremely important for your investing future. First, you have to understand the foundation of this graph because it's about to get more complicated, and I want you to follow along with this. This is the bond market's estimation of future inflation. It's called the 5-year break-even chart, and it measures the difference between the 5-year Treasury and the 5-year TIPS, which is an inflation-protected security. Now, don't worry about the complicated details of how that works. Just know that as this line goes down, the market is screaming, we think inflation is about to plummet. In fact, we are now at the lowest level in the 5-year break-even chart that we have seen since, folks, look at this, last July. That's remarkable. We are at such low levels now of inflation expectations that we have eradicated all of over here the delta expectations of inflation and the war expectations of inflation. They're gone. But now we need to overlay something very important. This is the 5-year break-even chart. That's the white line that you just saw. It's the same one zoomed out all the way back to 2020 or 2014. So this is the same white line that you saw here, and these orange lines here representing this fall are right here. This is that fall that you saw zoomed in on. Now, why is this chart so remarkable? Well, this chart is so remarkable because we took the 5-year break-even and slapped on top of it the blue line. The blue line represents year-over-year inflation. And what I want you to see is the inflection points that happen in this chart. Let's go over here together. See this inflection point right here? You can see the white line, the 5-year break-even line, inflects up right before we get an inflection up in the green. Over here, the same thing. You see the white line inflects up right before the blue line inflects up. You can see that again here. The white line inflects up, inflation inflects up. You see that here. The white line inflects down, the blue line or inflation inflects down shortly after. Then the white line bottoms and inflects up. Shortly after, the blue line comes up. Then we get an even more steepening in the break-even expectations. We get a steepening in the blue line. This is over the past 8 years. It's been very consistent. And yeah, there is an opportunity right here to say that one fell before the other. But frequently, a massive inflection in one is followed by a massive inflection in the other. And so what do we have right here, folks, at this tippy top here? We have a massive inflection point in the white line, which has now gone all the way down to this orange box here. What has not come down yet is the blue line. However, if this chart is correct, we are about to see inflation via the blue line potentially peak, but then plummet. If inflation plummets, then the Federal Reserve can be less aggressive in tightening monetary policy, and the Federal Reserve might say, you know what, now our goal is to avoid a recession, or to minimize a recession. Let's support the economy again, rather than hurting the economy. And you know what that means? Stonks. Go burr. This is that same chart without my drawings on it, but showing you it's not just the 5-year break-even, which is the white line, but it's also the 10-year break-even, the orange line, which shows you the same style of inflection points. And folks, what are people doing? Well, in the first half, retail investors said, you know what? We're seeing this as the opportunity of a lifetime to buy stocks. Bank of America security clients were net buyers of U.S. equities towards the end of the second half, or the first half, for the first time in 4 weeks. Institutional clients like pension funds were also the largest net buyers, and the only ones who are still selling are stupid hedge funds. Just hedge funds. Bloomberg is now reporting that our PMI reports are still coming in high, but they're not representing the plummet that we're seeing in commodities yet. Remember, what happens first? Commodities plummet. Then after a delay, you see producer prices plummet. Price expectations paid plummet. And then CPI inflation comes down, which is your consumer inflation. And this is where, folks, we have to talk about one more thing. What should you invest in? Well, potentially something for you to invest in during this time is investing in something like electric vehicles. Electric vehicles already represent a more than 6% of the US car market, with a parade of new models that's about to ramp quickly, including Elon Musk, who just this morning suggested that maybe Tesla's next foray should be a personal and cargo van, and Elon Musk in the past has expressed his admiration for the Mercedes Sprinter. These are vehicles that should be very easy to build. They're not complicated like the Cybertruck, and they sell for a beautiful and delicious premium. Folks, right now, the leader in electric vehicles is Tesla, beating even BYD and the other electric automakers throughout the world. Tesla is growing its sales year over year, while all other companies are seeing declines in sales. Even Ford, who suggests that, oh, don't worry, we are selling hand over fist Ford Mach-E's. Yeah? Well, you know what else is happening with Ford? Ford isn't able to make a profit. Here's an article from June 15th from Bloomberg. Ford Motor Company's hot-selling Mustang Mach-E electric SUV and other plug-in models are being rendered unprofitable by the rising cost of raw materials, which fortunately have started coming down, but in this environment, Ford can't keep up with pricing power to actually make a profit. In fact, their chief financial officer says, we actually had a positive bottom line profit when we launched the car, but then commodity costs wiped that out. In fact, the more EVs that Ford says, the more Ford says, you're going to see pressure on the bottom line when we launch our EVs. They're not going to be positive. Really? So now you're going to sell cars at a loss just to say you're selling cars. Well, at least you're not Toyota, because Toyota right now literally is issuing a recall because wheels are falling off their electric vehicles. Oh well. And when we look at Bloomberg Score, Bloomberg, a publication that usually bags on Tesla, when we look at Bloomberg's equation for the most fuel-efficient vehicles that exist, what do we get, folks? The best green score models are, first, the Tesla Model 3. The most affordable Tesla, followed actually by the Lucid, then the Model S, the Bolt, the Model Y, and then towards the end of the list, some other contenders, like the Kia, and of course the substantially larger and heavier Tesla Model X. So folks, the question now for you is, If the Great Reset has come and gone, is it time to buy? What are you doing with your portfolio? Personally, I have no margin, and I am honored to take the money that I have to buy. And if you want to see exactly what trades I'm making in the diversified portfolios that I'm building on M1 Finance, make sure to join the programs on Building Your Wealth, link down below. Take advantage of that coupon code, and we'll see you before the price goes up.